So your career in finance is measurable, and the level that you're at right now determines everything about your life. How much you make, how hard you have to work, and whether you control your own destiny instead of being controlled by someone else's. So there's actually 7 levels of finance, and knowing where you are right now is critical if you want to climb higher. Each level requires entirely different skill sets, different sacrifices, and opens up an entirely different set of opportunities for you. So where are you right now? Let's find out. Level number 1, that's the intern. The timeline is 0 years. This is your starting point. So let's start off with compensation. Generally, you're looking at $20,000 for a 10-week summer intern program, which essentially is prorated from a standard, say, 6-figure $100,000 base salary. So experience required. Generally, you're going to be in college already. Very seldom are you going to be accepted into an intern program if you're not currently in college. They're looking for strong GPAs, ideally from a top target school, and maybe 1 or 2 finance clubs on your resume, and you're taking finance or economics in school right now. So you're right at the bottom of the food chain at this stage. You are fresh out of your first few years of university or college. You just landed your first summer intern position at an investment bank. And this is where it all starts for most people who decide to go down this path. Now, you're not making real money at this point. Maybe you're making the $20,000 like we suggested for the summer, which is what you'd be making if you were accepted at a summer intern position at a bulge bracket bank like Goldman or JP Morgan. Now that sounds good to a lot of people until you realize that you're working 80 to 100 hours a week. So do the math on that hourly rate. Suddenly, it's not so impressive. But the thing about level 1 is that the money doesn't actually matter. You're here to prove yourself. You're here to cut your teeth and secure a full-time offer at the bank that you had the summer internship at. Because if you're going down the traditional path without this internship, your chances of breaking into finance or investment banking, whatever it may be, directly out of graduation drops to almost 0. They want to see that you have real life experience working in the trenches. Now, according to Goldman Sachs, they received 315,000 applications for just 2,600 internships. That was in 2024. And the acceptance rate boils down to 0.8%. Getting into Harvard is literally easier than landing one of these spots. So that's why I always tell people to start an independent investment bank if they're looking to get into finance, rather than gambling with the often gate-kept and grueling corporate ladder. But more on that in just a little bit. Let's break down what your actual day would look like. You're building pitch decks at 2 a.m. You're updating Excel models for the 47th time because a senior banker changed one assumption that now results in you having to readjust the entire model, and ordering dinner for the team, hoping nobody asks you a question you can't answer on the call. You live on literally coffee and adrenaline. Now, this is all while your friends back home are enjoying their summer. You're in conference rooms on Saturday evenings learning how to format PowerPoint slides to your MD standards. But if you survive that summer and you get the return offer, you just bought yourself a ticket to level 2. Now, the key at this level is simple. Show up early, stay late, ask good questions, and never complain. Your job is to learn. It's to absorb everything like a sponge and to prove that you can handle the pressure. So let's move on to level 2, the analyst. Timeline here is 0 to 2 years after graduation. Compensation is between $170,000 to $220,000 all in, with a base of $110,000 to $120,000, and then bonuses generally between $70,000 to $100,000. Now, the experience required here is at least a bachelor's degree and surviving a summer internship at a reputable institution. You have to be able to build financial statements, work on pitch decks, and understand the basics of the work that would go into you being able to provide value to your live deal team at the actual bank. Now, this is your first real job. You're 22 years old. You're making more money than most people in their 30s if they went down some other path. First-year analysts at top banks now start with a base salary of, like I said, between $110,000 and $120,000. And that's before your bonuses. But before you get too excited, understand what you're trading that paycheck for. You work 80 to 120 hours a week, and that's every single week, not just busy weeks. Your weekends don't exist. You eat 3 meals per day at your desk. The bank provides free dinner because they know that you're not going to be able to leave until at least 11 p.m. You learn to sleep in the office. You keep a spare suit and a toothbrush at your desk you Uber home at 2 a.m., shower, and then be back at the office for 7 a.m. meetings. Your dating life is non-existent. Your friends outside finance stop inviting you out to things because you always cancel. Just to put this into perspective, here's what a typical day looks like. You arrive at the office at, say, 8 a.m. on average days. You spend the morning updating models and the latest numbers that you need to do. At noon, you attend a meeting where you present your work to your VPs and MDs, and they tear it apart. They send you back revisions, then you have to go and fix it. You grab lunch at your desk at, say, 2 p.m., and the rest of your afternoon is spent building more decks, running more scenarios, and responding to client requests. At around 7 p.m., this is where most people are already leaving for work. But this is where your real day begins, because now you have some time for deep focused work without having the distractions of everyone asking you to do things. That's when the senior bankers who've been in client meetings all day finally sit down to review your work and tell you what you need to do next. The comments come flooding in. This slide needs to be redone. This valuation is wrong. This needs to be done, etc., etc., etc. You're making changes until maybe 12, maybe even later if you need to turn something around for that next morning. And generally, you're going to be working on several live deals at a given time, which means this is going to be absolutely nonstop. The analysts who make it through are the ones who can execute perfectly under pressure. You're learning to work faster than you thought possible. You're learning to work even if you're sleep deprived. You're developing an eye for detail that borders on obsessive, and you're building a skill set that very few people in the world possess. But here's the harsh reality. A lot of analysts don't make it to year 3. They simply can't stomach it. Many leave after their first 2-year programs up, burned out and ready for something else. For those who stay, you're promoted to associate after 2 or 3 years, and that's when things start to get interesting. So we move on to level number 3, the associate. Timeline is between 3 and 5 years total experience. Compensation is between $240,000 and $400,000 all in. The experience required is either being promoted from an analyst or came in directly from an MBA program in a top 15 school. You've made it to level 3. You're no longer the most junior person in the room. Associates, like I said, earn between $240,000 and $400,000 a year, depending on your accolades and your past performance. First-year associates start out at around $240,000 to $270,000 a year, and by the third year as an associate, if you're performing well, you can push $350,000 to $400,000. But hours are still brutal. You're still working between 70 and 90 hours a week, but there's now a shift in what you're doing, what the actual work entails. As an analyst, you are in the trenches. You are doing the hard manual work. You are building out all of the models. You are creating the decks, etc. As an associate, you're now managing analysts and starting to interact with clients. You're in more meetings, you're in more calls, and you're bridging between the junior analysts building the models and the senior bankers managing the client relationships. You're expected to run the process now. When a pitch goes out, you're the one making sure all the materials are perfect. When a deal goes live, you're coordinating between the team members, making sure nothing falls through the cracks, etc. Now, here's what separates the good associates from the average ones. Good associates make their MDs look good. You anticipate what they need before they ask for it. You catch mistakes before they happen. You handle the details so they can focus on bringing in business and managing client expectations and client relations and doing the actual selling, the soft skills that go into this business. Now, at this level, you're starting to develop a reputation. The MDs in your group and your live deal teams, they now know who you are. Other groups in the bank have heard of you maybe. You're starting to become known for being reliable and thorough or incredibly fast at whatever your strength is. But you're still not in a position to be a revenue generator. You're still working on someone else's deals. You're executing their vision, not creating your own. So to get to the next level, you need to start building your own relationships, originating your own ideas. And you need to show that you can bring in business, not just execute on building out models and directing analysts to create slide decks. So most associates get to the next level, which is vice president or VP, somewhere between year 5 and year 7. That's when you cross the threshold into real money and real autonomy. So level 4 is vice president. Timeline is between 10 and 15 years total experience, and compensation now starts to get into the upper range. You're looking at between $500,000 and $2 million for salary. This is before bonuses. Now, the experience required is a proven deal track record, a client network, you can originate business and close deals independently. This is where things start to get real. A VP typically hits this around 5 to 7 years of being at a specific institution or total years in investment banking experience. Now, when you start off as a VP, you're going to be making between $500,000 on the low end and $700,000 on the high end in your salary in your first couple of years. Now, VPs who arrive around year 10 to 15 earn anywhere between $800,000 and $2 million or more, depending on how much business experience and how much business they actually bring into the firm. At elite level boutique firms like Evercore or Centerview, top VPs earned over $1.7 million on average in 2024. At the biggest banks, that range is even wider, anywhere between $500,000 to $5 million, depending on your book of business. So here's the fundamental shift at this level. Your compensation is now directly tied to revenue generation. You're bringing in deals, you're bringing leads in instead of just working on them. As a VP, you're starting to develop your own client relationships. You're starting to go to conferences more so, and you're starting to be taken more seriously in the room when you're at those conferences. You're talking directly to CFOs. You're pitching new business alongside MDs. You're learning what it takes to be a rainmaker. And by the time you hit MD, you are the rainmaker. You have a roster of clients who you can call when you're thinking about a transaction. You have relationships with private equity firms who can bring their deals to you, or you can bring your deals to them. You have a list of family offices, and you have a reputation in your industry that precedes you. Your day is completely different now. You're not in the office grinding on models. You're in client meetings. You're at the golf course. You're at dinners. You're flying out to meet CEOs and board members. And here's what people don't tell you. This is the level where most people hit a ceiling. Not everyone can be a great MD because it requires a specific personality. You need to be able to sell, to be comfortable with rejection, to be able to schmooze with billionaires and decamillionaires and centimillionaires and make them trust you with their most important decisions. Some people who were incredible analysts or associates never figure out how to originate business. They plateau at VP. They make decent money anywhere between $500,000 or $800,000, but they never break through to the top tier. And the ones who do break through are thinking about the next level because there's an entirely different game that opens up once you've built a real book of business, which leads us to level 5, which is the finance founder path. You create your own independent or boutique investment bank or advisory firm. Now, the timeline generally here is 15 plus years of experience before launching. Compensation is usually, on average, between $3 million and $10 million a year annually. The experience required is deep industry relationships, credibility clients will follow, enough capital saved to survive the lean startup years. So you've spent around 15 years building relationships at a bulge bracket bank or another large boutique. You've built a book of business with clients that trust you, but you realized that at the end of the day, you are making the bank rich. You are not making yourself generationally wealthy. So you leave and you go to start your own independent shop. This is level 5. Now, this is an entirely different level of risk. When you're at Goldman or JP or you're at Evercore, you have a salary, you have a bonus pool, and you have a brand, a plate of armor that you can wear when you walk into the room that literally opens up doors for you. When you go out on your own, you have none of that. It's all on you. So here's what a successful boutique looks like. You're bringing in around $250,000 per month in engagement fees. These are upfront work fees that you charge your clients. And then you're making around, say, $3 million a year. So that's $3 million a year just from your retainers or your work fees. And then you close a few transactions per year. Maybe you do some M&A advisory work where you earn a success fee of $2 million to $5 million per deal. Maybe you've helped a company raise some debt or equity and you take a 2 to 3% fee on the capital raised. All in, a successful boutique founder will be doing between, say, $2 and $10 million a year in annual revenue. But here's the catch. Your first 2 years will be absolutely brutal. You're living off savings while you're building your client list. You're hustling for every engagement. You're proving that you can deliver without the big bank behind you. Some founders fail. They realize their relationships were not as portable as they thought. The clients don't follow them, and the deals don't come as easily as they once did. But the ones who succeed have built something special. They own their own destiny. When they close a deal, they're not splitting the fee with 47 different people. They're not reporting to a management committee. They're not navigating office politics. The boutique model works best in specific niches. Maybe you specialize in healthcare M&A, and you did that at your bank for the past 15 years, and you know every major player in the industry. Or maybe you focused on middle market tech companies, and you have relationships with every equity firm on the West Coast that funds these kinds of organizations. Or maybe you took a similar path as I did and hired people with more experience than you do to leverage their credibility in the gate-kept world of high finance, which is how I was able to get to this stage within 2 years instead of going down the normal path, which is over a decade. So the point is, you are leveraging deep expertise and relationships to win businesses that big banks can't always compete for. You're nimble, focused, highly profitable per person, but even at this level, you're still just one player. You're not moving markets nor shaping policy. You're running a successful business, but you're not at the absolute top of the food chain. Now, here's something most people don't know. That 15-year timeline isn't the only way to build a boutique anymore, or an independent firm. Some people are starting their own investment banks without ever working at Goldman or Morgan Stanley. They're learning how to find companies that need capital, or need to structure deals, or need fairness opinions, or need to sell their company, which is the same business model, just an entirely different path to get there. But if you do stick with the traditional route and keep climbing, there are 2 more levels above the boutique founder. This is where the real institutional power lives. Level 6 is the executive. Timeline is between 20 and 30 years in the industry. Compensation starts at $5 million a year, all the way up to $30 million plus, with stock, options, and bonuses. Experience required is obviously decades of proven performance, built entire divisions, a network across Wall Street, board experience, strategic vision, and tremendous amounts of value add beyond that. You're in the C-suite of a major financial institution. Maybe you're the CFO of Morgan Stanley, the president of Bank of America's investment banking division, or the CEO of a large regional bank managing $50 billion in assets. At this level, you're not working on individual deals anymore. You're managing thousands of people. You're managing the people that manage the deals. You're responsible for the entire business lines, generating billions of dollars in revenue. Your compensation reflects this. Your base salary might be $6 million, but the real money comes from the bonuses, the options, and all of the equity participation that you are going to be granted. Total comp packages for executives at this level can range into the 9 figures, even more in some instances, depending on the situation, the institution, and the performance that you're able to drive for the company. So let's look at some examples. Goldman Sachs CEO David Solomon made $39 million in 2024. Bank of America's top executives make $15 million to $25 million. Regional bank CEOs make between $5 and $10 million. Now, this is what's being reported, but likely they're earning far more behind the scenes on specific deals that they're participating in that they don't have to disclose to the public. Now, your day is meetings, it's board meetings, it's investor calls, it's strategy sessions, it's meeting with all the department heads, it's regulatory discussions, meeting with regulators. You're thinking about hiring plans, technology investments, risk management, and how to position the firm for the next decade. You're thinking long-term. You're getting rewarded for high-quality decision-making. You're getting paid for the quality of your thinking. It's not about the quality of the manual work that you're doing. At this level, you have actual power. When you make a decision, it affects thousands of employees, billions of dollars. When you speak, the media pays attention. Industry conferences, they want you to be a keynote speaker. They want you to be a panelist. And with this, it means that you are incredibly visible, which means if your firm has a bad quarter or a bad year, you're the one responsible to the shareholders. You're the one who has to take the heat from the investors. If there's a scandal, you're testifying before Congress. If there is a strategic misstep, the board is asking you tough questions about your leadership capability and fitness. The path to level 6 is long. It typically takes multiple decades for you to reach these positions. You've survived multiple economic cycles, you've built and run successful businesses within the firm, and you've proven that you can manage through crises. Most importantly, you've navigated internal politics successfully, because at this level, technical skills matter less than strategic vision. your interpersonal dynamics with other people, your ability to maintain and create power, your ability to influence other people. But even some CEOs of major banks aren't at the absolute pinnacle. There's one more level reserved for the tiny handful of people who don't just work in finance, they are the industry. This is level 7, the global titan. Timeline is 30 plus years, multiple decades of dominance. Compensation is $30 million to $50 million plus annually, potentially hundreds of millions in options, in bonuses, and in other opportunities that go outside of the bank's earnings. Experience required is multiple decades of building an empire, surviving multiple crises, transforming entire organizations, relationships with heads of state. We're talking about presidents, prime ministers, the head of EU, United Nations, the chairmans of all the central banks around the world. At this level, we're talking about the likes of Larry Fink, Steve Schwartzman, Jamie Dimon. These are all guys at level 7. Larry Fink, the CEO of BlackRock, he made $30.8 million in 2024. But that number doesn't tell the full story. He runs a firm that manages over $10 trillion in assets. So when Larry Fink publishes his annual letters to shareholders, global markets pay attention. When he speaks about climate change or stakeholder capitalism, corporate boards around the world shift their strategies. Or Jamie Dimon, who's the CEO of JP Morgan, he made $39 million in 2024. He runs the largest bank in America with $3.7 trillion in assets. When there's a financial crisis, the Treasury Secretary calls Jamie Dimon for advice. When there's economic uncertainty, CNBC wants him on camera giving his take. Politicians seek out his counsel. His opinions on interest rates move markets. At this level, you're influential in a way that very few people in the world ever achieve. Your decisions don't just affect your company, they ripple through the entire global economy. You have direct relationships with central bankers, with heads of state, and the most powerful CEOs in the world. You don't call them, they call you. When the president needs to understand what's happening in the markets, you're the one in the room. You speak at Davos, you sit on powerful boards, you're invited to exclusive conferences where global policy is shaped. You influence what's written in the books that business students study. Your career is a case study at London Business School or Harvard Business School. But here's what most people won't understand about level 7. You can't just work your way there through sheer determination and intelligence. Those things are absolutely required. They are the base level foundation. They are a prerequisite, obviously. All of these things are a prerequisite to even being accepted into the first level. What sets level 7 apart is vision, it's timing, it's the ability to create a culture, having people follow you, believing in everything that you say. Larry Fink, for instance, started BlackRock as an affiliate of Blackstone, and he had the vision to build the world's largest asset manager by focusing first on risk management technology and ETFs. He positioned BlackRock perfectly for the post-2008 world. Jamie Dimon took over JP Morgan in 2005 and navigated the 2008 financial crisis better than anyone. While other banks failed or needed bailouts, JP Morgan remained strong. The crisis-tested leadership cemented his reputation as the best banker of his generation. These guys are considered once-in-a-generation leaders who transform the financial industry. At level 7, money is no longer the motivation. You already have more money than you could spend in 10 lifetimes. Your stock holdings alone are worth hundreds of millions or billions of dollars. What drives you now is legacy, what you leave behind. How will history remember you? What did you build? How many lives did you affect while you were here or well after you were gone? What did you change? Did you make the system better, more stable? Did you democratize investing? Did you influence how corporations think about their roles in society? Very few people ever reach level 7, but 5 to 10 people at any given time occupy this level. It requires not just skill and hard work, but being able to be in the right place at the right time with the right idea and then executing flawlessly for decades. So there you have it. Those are the 7 levels of finance. Maybe you're at level 1 or level 2, or you're not even at level 0 right now, grinding through those first few years of being an analyst or an associate, wondering if this is all worth it. Or maybe you're already at level 3 or 4, trying to figure out how to become a rainmaker and break through to the next tier. Or maybe you're thinking about taking the leap to level 5 and starting your own firm. So regardless, wherever you are, the path forward requires 3 things. The first, you need to develop skills that compound over time. Master the fundamentals early. Learn to build models faster than anybody else, to think strategically about deals, and communicate effectively with clients. Second, you need to build relationships deliberately. The person you work with as an associate might become a VP at a tech company in 5 years. The analyst you manage right now might introduce you to a client 10 years from now. Invest in people, invest in relationships. It pays dividends for decades, for your entire life for that matter. Third, you need to understand each level requires a different set of strengths, different skill sets. Being a great analyst doesn't automatically make you a great MD. Being a great MD doesn't automatically make you a great CEO. The skills that got you here, or to the level that you're at right now, aren't necessarily going to be the skills that get you to the next level. But here's the good news. Finance rewards performance more than any other industry on the planet. If you're good, you're going to be promoted. If you're great, you're going to get rich. And if you're exceptional and a little bit lucky, you might just change the entire industry, or the world for that matter. Now, I mentioned earlier that some people are building boutique or independent investment banks or advisory firms without spending 15 years climbing the traditional ladder. And if that idea interests you at all, I put together a completely free training on exactly how this model works, from start to finish. In that training, I'm going to walk you through how people, even with zero finance background, are closing deals worth hundreds of millions of dollars, how they're collecting the same amount of upfront engagement fees and success fees that level 5 boutique founders earn, and what are the specific systems they're using to find companies that need capital and structure deals and get paid without needing a Goldman Sachs resume or an Ivy League degree. Plus, you'll see actual case studies of people who went from zero finance experience to closing their first deals within a matter of months. The training breaks down the real numbers, the actual process, and how the whole thing works in excruciating detail from front to back. So if the idea of skipping 15 years of unnecessary work and starting to build your own independent boutique sounds interesting, then click the free training down below. It's in the description, and I'll see you there.